This is Charlie giving you Monday's market commentary. I hope you're very well. I've just put a blank screen up at the moment. I just wanted to cover off just a topic of discussion, really, and that is what do you do after a loss or maybe a losing streak or whatever. And so I just thought I'd cover this off because it's such an important part of trading, like so many aspects of trading. Well, there's probably two things that traders are susceptible to doing. Okay, so after a loss or losing or a losing period, now a losing period could be, a day if it's a day trader, a losing day, or it could be a week if it's a swing trader. Could even be a week if it's a day trader as well, I guess. So what are traders likely to do? Well, one is that traders may move away from it and stop trading after having a loss or losses. So they may stop. And so through fear of further losses, they stop trading. Or the other one is they actually start to double up or trying to make back the loss too quickly. So they're probably the two things, the two reactions that you'll see amongst traders. Now this one, obviously trying to make back the loss too quickly is a dangerous game because you're susceptible to over trading, obviously doubling up, and we know traders will do it. Certainly I've done it in my history. And we all pay the price for that because sometimes it would work out for you. Obviously you could double up and you could still have a winning trade and you make back your losses quicker, but usually it ends up where you double up and then you lose more, and so that's a no-no, obviously. But also this is a no-no too, because the traders who stop trading through fear are then missing out on quite normal opportunities. So what do you actually do? Well, there's nothing wrong with stopping for, let's assume you're a day trader, maybe for a day, and just saying, do you know what, I've just not had a good day today, I'm just going to take a day off tomorrow. Well, that's fine. We can certainly do that, but you need to get back into the seat and back into the saddle. And the main thing, though, is to then trade at either the similar size to what you were trading before. So either trade at similar size, position size I'm talking about here, or downsize, because it helps you psychologically to get back into the saddle by downsizing or trading at a similar size. But whatever you do, you don't want to really trade bigger. Just whilst you're going through that, what does that actually mean? It means that actually it could take you longer to make back your loss or your losses, but that doesn't really matter in the grand scheme of things, because it just means that you'll end up trading better as you readjust, reacclimatize. So let's say you normally trade at, for argument's sake, £1 per point. So you trade at £1 a point, you have a series of losses, and you think, okay, I've really not been good there. I took a couple of trades which just weren't good quality trades for whatever reason. You've had those losers. Well, maybe take it down to 50p a point when you get back in the saddle, because psychologically it won't feel as hard as trading if you go straight back in at £1 a point. So yes, it means it's going to take a little bit longer, but it also means that you'll get back into the groove a bit quicker by trading at that level. And so, okay, so let's assume, for argument's sake, if you were trading at a similar size, for whatever reason, let's say it's going to take you a week to make back your losses because you've had a series of losses. Let's say it's going to take you a week if you're trading at a similar size, which is £1 a point. So at 50p a point, it may take you 2 weeks. Now, in the grand scheme of things, when you're trading over the course of a year, does that really matter, 2 weeks? The fact that it's taking you that little bit longer? Well, no, it doesn't. And so, because if I take the pen off and clear that down, and let's bring it back up again, because it is the old 80-20 rule. The old 80-20 rule, to a large extent. What we do is, as traders, we spend the year whereby probably 20% of the time, that's what makes us the majority of our money. That's what gives us those trades that give us the cream, the big wins, or just the meaty trades. So that's our meat, and then the 80% is the bread and butter. So that includes the losers and all of that, the missed opportunities, the missed trades, missed trading as a result of holidays, and all those other things. And so much of the 80%, you can actually be, if you look at all of your trading, you could essentially be going sideways, more or less, with a slight incline for a lot of this 80%. But it's the 20% which gives you your equity curve that's doing that. So all we have to do is to ensure that the majority of the time, as much of the time that we can, we're trading normally. So because that's what allows us to catch these moves. So all the time we're trading normally, yes, we're getting our bread and butter. So we're making some money on some. So we're getting some nice winning trades. Then obviously we have some losing trades in there as well. We're making some winning trades, and you're gradually, the equity curve is moving up like this. But then out of those, now and again, you're going to get those bigger winners, and those are the ones, or it could be either bigger winners, or it could be a spell of winners, where you just go for a really, really good spell. So it's either one of those, and that's what really then pushes your accounts up. So when it comes to trading, downsizing after having a loss is not a bad idea. If you feel fearful, downsize your position, because it just means that yes, it may take you a little bit longer to make back that loss, but it will get you back in the saddle quicker than if you're too fearful of trading back at your normal size. And it ensures that then you are participating in the market, because you never know when that next winning streak is going to happen. Right, okay, let's get on to the market commentary. So first off, I just want to draw your attention to the Mcclellan Summation Index, and because over the months this has continued to make new highs, and so that's just bodes well for the markets in general. Now at some point it will obviously stop, and you never know at what point it's going to stop making new highs, but for the general structural health of the market, you've got the breadth of the market, which is the Mcclellan summation, has been making new highs, which tells us that stocks in general are doing well, and that until told otherwise, then the breadth of the market is good, is sound. So, and if we go to the market itself, so we go to the S&P 500, then we can see, yes, of course, it's in that, and it's still in that uptrend. Yes, it's been weak over the last week or so, went sideways for a long time, and then it's just backed off. But at the moment, like I've been saying for weeks and weeks and weeks, the trend remains up. So until told otherwise, the trend is up. So that's the main thing to mention there. Gold. Let's have a quick look at gold, because gold's obviously had such a good run. Let's take this out to maybe a weekly chart. Again, gold's consolidated over the last week or so, so it's got a bit choppy. Overall, it tells us that, like I said several weeks ago, that it's going to find resistance up in this zone from these prior highs over here. And as you can see, we've posted a doji basically on the 2 weeks, over 2 weeks. So a little bit of indecision taking place here, but the moving averages are catching up now. The 8-week moving average is catching up with it. So it's just now a case of, if we take it back down to the daily chart, whether it's going to break out. So see if it's going to break out of these highs. But the only thing is, there is a potential divergence in place. So it's the main thing I was saying was that it was better in this zone, because I said, look, we've got some open space up to these prior highs, and then it's going to struggle with that resistance for a while. But if it was to break out, let's have a look, then really we're really starting to get over 1800, and well, really into the mid 1800s again. So the potential's there, but there is, like I said, potential. Even if it was to break up, you'd need to see a nice solid break with a nice solid close, I think, on the candle. So a nice solid close, like a candle like this one here, would be a benefit to it if it does break out. That should suggest that it should do better. But when you get the potential divergence in place, it always makes it a little bit more tricky. So that's that. Let's go to the currencies. Now the euro was weak again on Friday. I thought we were going to turn up on Friday. Sorry, this is Friday's candle here, but then this is Sunday night's candle. The telecharts put an extra candle in for Sunday night trading, but it's obviously having a very good run here this morning. So it seems to finally be putting in a bit of a bounce. So well, it's already back up above its hourly 50. So for now, it's finally putting in a bit of a bounce. The trend I've been saying is still up, and so the fact that it's just pulled back down to its 200-day moving average, had a bit of a dip overnight, but it's having a tremendous run this morning, and so I think it's going to be a case of continuing to look for, if you're a day trader, for longs on an intraday basis. Although much of the upside has probably already been done today. If I take you to a 5-minute chart, you can see just what a run it's already had there today. So, but the trend remains up, and so I think that if we can hold above the hourly 50 for you intraday traders over the next several days, then there's probably a little bit more bounce potential in this market here on the euro. That's me pretty much done. We're at 10 minutes already due to the training, so shall I leave it at that. Kim will be back in touch with you on Wednesday.